Hi, Matt McAleer, Director of Equity Strategies. The 17th of September, just after the close. Have a special guest with me today, Shaun Burgess. Shaun sits on our fixed income trading desk. He's a portfolio manager and trader. He's going to give us some insights on what he's seeing in terms of economic indicators that may affect how Cumberland positions their bond portfolio. First, let's do a quick review of what we're seeing in the equity markets. Equity markets dreary like the weather. A little bit of a pullback, little chop, little backing and filling. S&P, NASDAQ down about 1% this week. Over the last 30 days, the Dow down about 3%. That's been the leading draw. It was nice to note that the Russell 2000, the broadest indicator that gives us a peek into breadth, was up today and had a solid week. In terms of what we're seeing in sectors, it's really been a rotation. We've talked about that all year. We've had to barbell sectors, we've had to barbell growth and value, and we continue to do so. As you know, in the past, we talk about cross-market indicators that we like to analyze at Cumberland and how that helps us position client capital. I wanted to share a chart with you today. It's the 10-year Treasury yield. Not price, but yield. And this is from one of the services we've used for years, Dorsey Wright. This is a point and figure chart, very effective in tracking supply and demand. And what I'd like to point out is on the far right-hand side of that chart, you see what we call a quadrupled top pressing up against the 1.375 interest rate level. This is the fourth time the 10-year has bumped up against that level. Historically, in trading, the more times you bump up against the level, the better chance you have of breaking through it. That also goes with downside pushes. The more times double bottoms, the more times you threaten a bottom, the better chance is you break through. So on this particular chart, of interest to me is what would happen to our allocation equity-wise if the 10-year was to break through this 1.375 area. We might have to start overweighting some areas that we don't have a big allocation to right now. Banks, financials, insurance companies, interest rate sensitive areas, areas that have struggled a touch with rates falling the last 6 months. So we'll be examining those areas over the next week or two with an eye on the bond market. Just because we're managing equities in our equity strategies doesn't mean we don't take a look at other asset classes. Be very interesting. Shaun's been keeping an eye on some economic indicators this week. Why don't you share with us what you saw, what you noticed?
Thanks, Matt. Yeah, the economic indicators this week were fairly mixed. We saw a initial jobless number that came in line. We had inflation numbers that were, again, slightly less than survey, but the real surprise was on the retail side.
Yeah.
Good retail numbers. The conversation in the fixed income markets is definitely around tapering and what tapering is going to look like as far as timing and breadth, how the Fed is going to move when they do start to taper. So all these numbers really play into that, and they're why we really try to keep track of them. And no one number is going to be a good indicator. It's really the trend you see in the numbers. So we continue to watch those very closely. The retail number really makes you think the economy is rebounding from any Delta variant contagion.
Yeah, that was the fear, right, Shaun?
That was the fear.
With
we saw
Delta,
Treasuries respond, and that retail number came right back up. So
yeah.
Treasuries ended up fairly flat on the week in the face of that retail number. It was a good number. It's good to see the economy really rebounding from any contagion that Delta may have, or the Delta variant may have dealt us. So
good. So from a fixed income standpoint, we'll continue to barbell the portfolio, and if we can get this push higher in yields, which we're starting to see some technical indication for, we'll have some money to push out on the far side lock in some coupon.
Yeah, you get defensive in the face of it. You really want to be nimble as you get into this kind of environment where you have yields moving higher. So, we've been defensive for a while now, and we're going to continue to be defensive while still taking advantage of any market dislocations or opportunities we may see from either a duration of credit standpoint, although we do maintain a very high standard as far as credit goes. So,
great info.
You really got to be nimble here and pick your spots to allocate.
Great info, Shaun. Thank you for joining us. We'll keep an eye on interest rates next week and how it may affect how we position both bonds and equities. Have a great weekend.
Have a good one.